Welcome, and thank you for joining me for this weekly episode of the Market Whispers podcast. I am your host, Beachman, and I am super excited to have you here today. Today is Friday, April 26th. Now, right off the bat, I must clarify that I'm not a financial planner, and anything that you hear or read in this podcast is not financial advice. So please do your own due diligence and consult a licensed financial planner. And before I forget, please do me a favor and spread the word about this podcast and my newsletter. I keep the cost for my paid content very reasonable. It costs less than 3 lattes a month. My paid subscribers know the value that they get from my research, from my writings, from my market analysis, from the active chat line, and from this podcast. Just this week, in fact, I wrote to my paid subscribers about a handful of stocks that I'm closely watching during the current Q1 earnings season. Every quarter, I use my Beachman scoring algorithm to identify some top pick stocks, some potential leaders in waiting, the most improved stocks, the companies that improve the most in terms of their business performance, as well as business fundamentals. And I also, on the other side, identify stocks to avoid, stocks with stagnating growth prospects, declining business fundamentals, and highly risky future business performance estimates. And I publish this scorecard every quarter. I publish this to my paid subscribers every quarter. And as I said, I use this to identify stocks that I might be interested in adding to my portfolio, as well as stocks that I may want to avoid. And I just published this most recent, most up-to-date stock scorecard to my paid subscribers last week. So please consider becoming a paid subscriber. Tell your friends and family. I'd love to have them and you join the growing Beachman community. And by the way, this podcast is also available in YouTube format. About 24 hours from now, I usually publish this podcast on YouTube under the YouTube channel called Invest with Beachman. So look for this episode on YouTube and join me there as well. Now on to the beat of this episode. Well, as of this Friday's close, the major averages, the major indexes are on track for a winning week. The S&P 500 and the NASDAQ are on pace for closing out their best week since November last year. The S&P 500 is up about 2.8%, and it snapped a 3-week losing streak. The NASDAQ gained more than 4%, and it headed for its first positive week in more than 5 weeks. The Dow Jones is lagging with up just about 0.7% for the week. Now, this is quite a change in character from the doldrums of last week. If you remember, last week was a major down week for the markets. Last week, broader market indexes lost anywhere between 3 to 5%. Even the Russell 2000, the small cap index, decreased by about 3%. And market sentiment was very, very negative last week. In fact, for the last 2 weeks, things were fairly up and down and mostly down. Market sentiment was affected by factors like rising interest rates, higher for longer. Markets were also impacted by geopolitical tensions, as well as sector-specific weakness concerns. And most of the pain was felt in the semiconductor sector last week. The semiconductor index, the Philadelphia Semiconductor Index, lost about 9% last week itself. The company Supermicro, SMCI, was down a massive 40% last week. And NVIDIA, the darling of the AI crowd, NVIDIA saw a sharp decline of more than 10% last week. Now, so far, with this week's recovery, the S&P 500 is up more than 6% for the year. The NASDAQ is up more than 4%. Mid-caps are up more than 4%, and the Dow Jones is up almost 1.5%. So for this week, as we entered this week, I was looking for 3 signals that would tell me whether markets would continue its larger bull run. There were 3 specific signals that I was looking for. Signal number 1, I was looking for good PMI readings, and we got those readings on Monday. Signal number 2, I was looking for bullish and good and strong Q1 earnings reports from the hyperscalers. And we'll talk a little bit more about that. But generally speaking, we got that. And signal number 3, I was looking for a decent PCE inflation report, which we got this morning. Now, this morning's PCE inflation report was kind of mixed, kind of lukewarm, but I'll take that. So out of the 3 signals, I would say we got 2.5 signals for what I was looking for. Markets turned upwards and they didn't look back. They were positive for most of the week and closed out on a very strong note. Now, Oppenheimer Research, their analysts predict a rally in the second half of the year as they expect rates to moderate, meaning there could be 1 or 2 rate cuts towards the second half of the year. This lines up with what I'm expecting as well. I'm expecting at least 2 rate cuts starting in July. Now, as per Jurian Timmer, who's the chief analyst from Fidelity, Jurian says that after the 6% drawdown that we got since end of March, the forward PE ratio of the S&P 500 has declined from over 21 to less than 20, so around 19.9. And Jurian says that this is a good thing. Valuations of stocks, generally speaking, valuations were much higher than they should have been leading into the start of the second quarter in April. And now some of those valuations have pulled back, and that is a good thing. So as prices have pulled back, valuations have pulled back, they're still relatively elevated. As prices have pulled back, earnings estimates that we're starting to see from the Q1 earnings report seem to be more positive than what analysts were expecting. In Q1, earnings estimates for the S&P 500 companies are expected to rise about 12% year over year. And as these earnings increase and as these earnings rise, they could in fact justify some of these higher valuations that we've been seeing for certain stocks. So now in Q1 2024, earnings are growing. Now, this was not the case last year in October. If you remember last year, we got a very deep market drawdown. And what was happening at that time was valuations had pulled ahead, so far ahead of earnings, and earnings were not keeping up with those valuation rises. And therefore, markets pulled back and were looking for more solid reasons for moving higher. This time in Q1, we have a little bit of a better situation where earnings are rising in tandem with valuations. Now, the 2023 rally was mostly based on optimism about future revenue growth. This led to strong multiple expansion or higher valuations for our favorite stocks. Now in 2024, starting with the Q1 earnings reports, earnings growth is also coming in. And every quarter this year, analysts are expecting higher and higher earnings growth for our favorite stocks in the S&P 500 index. The higher earnings growth is going to be the backbone to support these higher valuations for stocks. Now, there is some downside risk. I mean, there's always downside risk, right? Markets go up and markets go down. The question is, how much further downside risk is there to current valuations? Well, that really depends on interest rates and inflation. Those are the 2 factors that could color how markets perform going forward. As per Bank of America's Savita Subramaniam, she's a Wall Street analyst that I very closely follow. Savita believes that there is still some downside risk to the S&P 500, all the way down to about 4682. So Savita believes that this could be, if we do have a correction, this could be a possible negative 10% correction, just about like the wobble we saw last October. But so far, so good, right? We've had a great 1 week of recovery. We'll dig ourselves up from last week's doldrums, one step at a time. When I looked at the S&P 500 index chart at the end of last week, I believe that our first target for recovery was to reclaim the 5,000 level, and we did that. Our next target was to reclaim the 19-day exponential moving average. That's the EMA that I use, the 19-day EMA. Some people use the 20-day simple moving average. But bottom line, we needed to reclaim one of these averages, which is equivalent to 1 month's moving average. And we did that as well. So we reclaimed the 1 month moving average as well, around 5,100. Now, the next target that I believe the S&P 500 has for next week is to reclaim the 50-day moving average, which is somewhere around 5,125. So that's the level that I'm going to be watching next week. 5,125. We need to get there sometime next week to keep this market in a bullish uptrend. Above 5,125, there are open skies. It could go higher unless there's some other financial or geopolitical shock that spooks markets. Now let's talk about macro updates. We got a couple of important macro updates this week. First off, we got the first reading on the Q1 GDP growth for the US economy, and it came lower than expected. Analysts were expecting Q1 GDP growth of about 2.5%. However, the first reading came in only at 1.6%. Now, when we talk about GDP growth, usually we get 3 to 4 readings on the economy over a space of 4 to 6 weeks. But this first reading of 1.6% was definitely much lower than what we were expecting. If you remember, in Q4 last year, the US economy grew a whopping 3.4%. It was a very, very large and healthy print. So this Q1 initial reading of 1.6% is less than half of that. So perhaps this early GDP reading is telling us that we are heading towards a period of some sort of moderate growth in the US over Q1, Q2, and Q3. I was expecting this kind of moderate growth in Q2, Q3, but maybe it's coming in sooner than I expected. The other important macro update that we got this week, in fact, today itself, we got the PCE inflation report. Now, you must note that the PCE inflation report is a report that is very closely followed by the US Feds. This is their preferred inflation report. So when they talk about tracking inflation and making interest rate decisions based on inflation readings, the PCE inflation report is the report that they look at to make their decisions. Now, this PCE inflation report for the month of March came in a little mixed. The overall inflation number, PCE inflation, grew by 2.71% year over year. Analysts were expecting 2.6%, so this came in slightly hotter than expected. In the prior month, in the month of February, PCE inflation grew 2.5%. So again, this was slightly higher than what we got in February. Core PCE, which is PCE inflation minus some of the food and energy categories, core PCE grew 2.82% year over year. This was again slightly higher than what Wall Street was expecting. However, it was in line with what we had in the month of February. So core PCE kind of came flat for the month, and headline PCE grew a little bit as compared to last month. So that's why I would rate this as a mixed report. Now, this is the last PCE inflation report that the Fed will see before their next meeting. Their next meeting is in fact next week on April 30th and May 1st. So they're going to make their interest rate decisions based on this PCE inflation report. And I don't think anybody in their right mind is expecting a rate cut from the Feds at this meeting next week. The Q1 earnings season has ramped up significantly. This week was a very busy Q1 earnings week. In fact, as of the end of this week, almost 40% of S&P 500 companies have reported their earnings for the first quarter of 2024. As I mentioned before, analysts are expecting earnings growth in this quarter for the S&P 500 to be a very robust 12% year-over-year growth. And in fact, looking at the rest of the quarters for 24, analysts are expecting strong growth throughout the year. For Q2, Q3, and Q4 of this year, consensus earnings growth estimates are somewhere in the 8 to 12% range. So the S&P 500 companies are expected to perform really well this year in terms of their earnings growth. Even if revenues stay stagnant or don't grow as high as they grew last year, earnings are expected to grow quite significantly to catch up with the revenue numbers. Netflix was one of the first large companies to report their earnings. Their first quarter earnings report exceeded expectations in subscriber growth as well as in financial forecasts. Netflix added more than 9 million subscribers worldwide. And today, they are the largest streaming service in the world with almost 270 million subscribers around the world. That's that's a huge number. Think about it. 270 million families around the world subscribe to Netflix's streaming service. Netflix saw a revenue increase in Q1 of over $9 billion, which is a 15% year-over-year increase. The other interesting earnings report that I noted, was for Taiwan Semiconductor Manufacturing, TSM. As you know, TSM is the marquee, the leading semiconductor manufacturing company in the world, and they are primarily headquartered or based in Taiwan. Now, TSM, their shares fell around 5% after they reported their Q1 earnings. The CEO expressed some caution regarding their overall forward growth in 2024. Now, he did say that demand for and revenues coming in for their AI and data center semiconductor manufacturing is still very strong. They're expecting a compounded annual growth in those two divisions, the AI and the data center semiconductors. They're expecting compounded annual growth of over 50%. But there are other sectors in their businesses that are not doing that well, and this put a little bit of a dampener on the stock price after their report came out. Their revenue grew 12.9% year over year in Q1, and they gave slightly muted forward guidance for their overall growth. SAP, a very large enterprise software provider, SAP reported their Q1 earnings. Their revenues grew 8.1% year over year. Now, what was important or significant in SAP's earnings report was the fact that their cloud revenue grew over 24% year over year. This was a big positive surprise in the earnings report. And they also updated their forward outlook substantially higher based on the growth that they are expecting, both in the cloud as well as in their software divisions. Well, you must have been living under a rock if you hadn't heard about Tesla's most recent Q1 earnings report, which we got last quarter. They reported a very significant miss both in revenues as well as in earnings. Tesla's revenue fell to $21.3 billion, which was negative 8.5% year over year. They missed Wall Street's estimates for both revenues as well as earnings. Tesla's margins are shrinking, their cash flows are shrinking. In fact, this was one of their first quarters of negative cash flow in a long, long time. Their growth in 2024 is expected to be significantly lower, but as CEO Musk says, it's going to be higher than 0%. So we'll see what they actually deliver. Talking about delivery, Tesla delivered 386,000 vehicles in Q1. This is one of their lowest vehicle delivery numbers in recent history. Now, Musk did announce some new products that are in their pipeline, and he shared with investors about some sort of timeline ETAs for each of these. Musk announced that they are going to be shifting their focus and quickly introducing what they call their low-cost EV. This is their sub-$25,000 EV, and he's promised to start delivering these EVs sometime in the second half or middle of 2025. This is much earlier than the previous 2026 timeframe that they had given. Musk also talked about their new robo-taxi product line or service, and they're going to have some sort of launch party in August. 8th of August, they're going to have some sort of announcement regarding the robo-taxi service. And then he also talked about full self-driving. Now, this is a capability, the autonomous driving capability that many Tesla owners today have the ability to subscribe to. And he talked about various initiatives to increase the adoption of FSD within the current Tesla ownership, as well as I think he mentioned that there's another third-party manufacturer that's interested in licensing Tesla's FSD capability. There are three other companies that we should talk about when we talk about earnings report from this week. Meta, or previously known as Facebook, their stock price dropped 10% after they announced their earnings report. Now, they had a 27% year-over-year increase in revenues, and they beat consensus estimates for both revenues as well as for earnings. Their earnings jumped 117% in Q1. But despite of this beat on both the top line and the bottom line, the stock dropped 10% because their guidance for Q2 was lighter than expected. So forward guidance or forward outlook was more bearish than Wall Street was expecting. Alphabet, or Google, this is another mega cap that announced their earnings this past week, and the stock was up about 12% after they announced or released their earnings report. They surprised analysts with a 15% revenue increase, year-over-year increase. And this was predicated on very strong revenue coming in from YouTube as well as from their cloud segment. Their cloud segment grew 28% year over year, and their cloud segment has actually grown higher and higher for the last 3 quarters now. And Microsoft was the last mega cap that reported earnings this past week. They surpassed expectations with a 17% year over year revenue increase. And it was driven primarily by growth in its productivity or its enterprise business software, as well as in their cloud segment. And their shares, Microsoft shares, rose by about 5%. So like I said, this was a very, very busy and important earnings week. And for the most part, it was much better. The reports that we got were much better than expected. And this kept markets in a buoyant mood all week. Now, despite strong earnings reports that we're getting that are surpassing expectations, the stock price impacts that we've seen based on these reports have been kind of muted as compared to what we experienced last year. Now, Julian Emanuel from Evercore Research, Julian told us that the broader market is having some digestion problems this earnings season. So what he said was that if you beat on the top and bottom line with your estimates, you're getting rewarded, but you're getting rewarded slightly less than before. On average, the 1-year price reaction is only about plus 1%. However, if you miss on the top and the bottom line, if you miss estimates on both revenues and earnings, you're getting punished twice as hard as before. And the average negative reaction for stocks that are missing on the top and the bottom line is about negative 6%. So investors are getting a little bit more impatient, and they are sharpening their pencils a little bit more as they evaluate the Q1 earnings reports that are coming in. Now, next week is going to be another busy earnings week. We've got a lot of big companies and important companies reporting. On the top of the list, we've got Apple that's going to be reporting, as well as Amazon. So these are two other mega cap stocks that are reporting. We've got consumer companies like Starbucks, McDonald's, and Coca-Cola. We've got several large healthcare companies, Eli Lilly, Moderna, CVS, Cigna, and Pfizer. They're going to be reporting next week. And then in the financial space, we've got MasterCard, Coinbase, and PayPal who will be reporting next week. So I'll bring the most important earnings updates to you in this podcast next Friday. Now, as we digest these Q1 earnings reports, one of the questions that we have to decipher for ourselves, analyze for ourselves, and think through as investors is, what do these reports tell us about the future economic health of the US? We hear a lot and we read a lot about the so-called potential decline in the American dream, the decline in the prosperity level of the US, right? The decline in the health of the US consumer. Wall Street always has a wall of worry, and this time there are increasing fears about what the future of the United States of America, especially the economy, is going to look like. I mean, sure, there are always risks, right? In my book, there are always risks, and right now in front of us, some of the major risks are possibly an inflation risk. We could have slower or lower or even negative economic growth. One of the risks that I am keeping an eye on and reading and learning more about is, what are the effects in the long term, what are the effects to the US economy due to the rising debt to GDP ratio? We've talked about that on this podcast before as well. And then I'm also always curious about, and I keep a close eye on the value of the US dollar, because the power of the US dollar has a significant impact on our ability to import and export to other countries and keep our economy healthy. I believe that the US economy, though, in general, is stronger than ever before because of one major reason, one big difference that the US has as compared to, one big advantage that the US has as compared to countries around the world. And that is innovation. Now, manufacturing industries used to dominate the US economy decades ago, right? We used to make all sorts of stuff in our nation here, textiles and televisions and automobiles and furniture, etc. We used to make them here in the US. And a lot of that manufacturing has since moved overseas to countries like China and India and Vietnam and even Mexico. The reason they've moved overseas is because the manufacturing costs are much lower in these other nations. Labor costs are much lower. So by manufacturing them outside the US and then importing them and selling them here, for decades we've been able to keep prices low for the US consumer, and we've been able to keep inflation to minimal levels. And even during and particularly after the pandemic, we went through a period of very high inflation. And this was a major possible risk to the health of the US economy. But we got through that period without much damage to the US economy. In fact, like I said, GDP growth last quarter in Q4 2023 was over 3%. That is massively healthy GDP growth for an economy the size of the US. The way we were able to tackle these issues was through, like I said, innovation. If US companies weren't innovating, we wouldn't have been able to create new products through the pandemic, such as vaccines that helped us reopen the economy. We wouldn't have created new services, such as a platform like Zoom, through which we started being able to conduct our business online and remotely. We wouldn't have been able to move into new markets and new products and new applications. Our domestic economy would not be growing and capital would not be flooding or moving into the US economy if we were not innovating as much as we could, as much as we did. Now consider this. The US GDP in 1930, right, all the way to 1930, the US GDP in 1930 was about $1 trillion. But at the end of last year, the US economy grew, US GDP grew to $28 trillion. So that's almost a 30x in growth of the US economy over that time period, right? Over about 70, 80, 90 years. During that same time frame, the US population has grown less than 3 times what it was in 1930. So while the economy has grown more than 30 times over that time frame, the US population has only grown 3 times what it was in 1930. And one of the main reasons why we were able to grow the US economy that much over that time frame with not as many people in terms of growth rate was, again, innovation. Right? Another aspect of the US economic prosperity is seen in the growing role of the US consumer in boosting and growing the US economy. The consumer has acted as this perpetual bright spot against a sea of macro uncertainty, even more so over the last 3 years since we got through the pandemic. Strong consumers have been vital to the health of both financial markets as well as the US economy. Now let's take a look at some of the tailwinds that supported consumers and the economy during this time frame, as well as some of the headwinds that provided resistance to consumers through this time frame. Let's start with the tailwinds. Number 1, jobs. We've had a very resilient labor market in the US that has been underscored by 39 straight months of job growth, counting the last month of March 2024. This is among the biggest positives for consumers today. We've had 39 straight months of job growth in the US. Just last month, the US added more than 300,000 jobs. and the unemployment rate fell to 3.8%. The second tailwind is wages. Now, wages have cooled a little bit from the extremely high levels that we saw in 2020, but they are still growing at a healthy rate. The average hourly earnings in the most recent report for the month of March, average hourly earnings were up 4% year over year. Now, real wage growth flipped positive in 2023. What is real wage growth? Real wage growth means that the wages that you're earning are higher than the inflation in prices that you're paying for goods and services that you typically consume in order to live a consistent, healthy life in the country. So real wage growth actually flipped positive in 2023 because wages grew much faster than inflation was growing last year. So these consumers continue to get bigger paychecks, which are allowing them to cushion the effects of high prices that they're seeing in the grocery store and even at gas stations. The third tailwind is the wealth effect. Consumer balance sheets have been buoyed by higher prices for both their homes as well as their financial assets. Household wealth in the US increased by $11.6 trillion in 2023, and this is up 8% year over year. Household wealth in the US collectively has reached a record level of $156 trillion in total. And like I said, this is up 8% year over year in the year 2023. The value of real estate by itself climbed over $2 trillion last year. The value of stocks that consumers hold climbed almost $8 trillion last year. So this increase in the value of consumers' asset portfolios is really keeping them in a positive frame of mind, and it has helped them continue their spending trend even into 2024. So against the backdrop of all of these positive factors, solid employment, strong wage gains, climbing net worth, consumer confidence has really stayed strong and remained strong post the COVID pandemic in 2020. Now let's talk about the headwinds that consumers are facing. It's important for us to understand what these headwinds are. Number one, we've talked about it, inflation, right? Consumers are facing elevated prices, and this is a huge challenge for them. Right? The economy is still working hard to get through that last mile of bringing inflation down to the US Fed's 2% target. We've made significant progress on this front since the 9% inflation that we saw in July of 22. But it's getting through that last mile that's proving to be slightly stubborn and slightly difficult. It's estimated that groceries today are costing consumers about 25% more than what they were paying at the beginning of 2020. So over the last 4 years, groceries have become 25% more expensive than prior to the pandemic. Consumers are spending more than 11% of their disposable income on food, and this is a 30-year high. This is at a high never seen before for the last 30 years. Gas prices get a lot of attention when it comes to inflation. But on the positive side, the US is now the largest producer of oil in the world. We are producing almost 20 million barrels of oil per day. This is very close. We're right there. This is very close to covering our country's entire daily consumption. The imports of oil coming into the US, those have been trending lower and lower since the peak of 2005, 2006. And these imports are almost down to zero. The next tailwind we need to keep an eye on is consumer debt. Consumers are increasingly turning towards credit cards to finance some of their spending at these higher prices. Consumers now owe an eye-popping $1.13 trillion in credit card debt. Yep, consumer credit card debt in the US grew to about $1.13 trillion by Q4 of 23. It increased by $50 billion just in Q4 last year, all of that holiday spending, I guess. And interest rates on this debt are at record highs. Delinquencies have started to spike, especially among consumers under the age of 39 that are still getting their feet on the ground in terms of being financially independent, as well as learning healthy financial habits. The third headwind we can see is in the savings balances for these consumers. Excess savings that consumers had accumulated during the pandemic have largely dried up. The US personal savings rate, it hit an all-time high of 32% in April 2020. That was right in the peak of the shutdown where everybody was at home, nobody was spending money on gas and traveling and commuting to their offices, nobody was traveling anywhere. So our personal savings rate at that time hit an all-time high of 32% in April 2020. And today, that same savings rate has declined to less than 4%. And that is below the historical average of about 8%. So consumers are spending more and they're also saving less during this time frame. So bottom line, the US economy is at some of its strongest levels ever. GDP growth is healthy, domestic oil production is healthy, capital markets are functioning well and drawing in investments from all over the world. The consumer is strong and has jobs and has spending power to support the US economy. And innovation continues to be one of our most fundamental and growing strengths within the US economy. And on the headwind side, we have to keep an eye on debt, on savings rates, as well as delinquencies. We have to keep an eye on the unemployment rate and the health of the consumer as a whole. One of the ways to monitor and measure the health of this market, one of the key indicators that we can use as we try to monitor these headwinds and tailwinds is long-term interest rates, and very specifically the 10-year interest rate and the 30-year interest rate. Now, long-term interest rates are one of the key barometers for what financial markets think about the future of the US economy. When long-term rates go down, bond markets are typically expecting a recession in the future, and they're expecting the Feds to cut interest rates to combat that recession. When long-term interest rates are rising, they are signaling that we could be seeing higher growth in the future. However, that could come with higher inflation, and that could be negative for consumer strength, consumer spending, and as well as the future prospects of businesses. So long-term rates give us a leading indicator to some extent of what they believe, what the bond markets believe could be happening in the US economy. And stocks typically move inversely to long-term rates. When long-term rates go up, stocks go down, and vice versa. When long-term rates go down, stocks go up. And this is especially true for small cap stocks. Small cap companies, small businesses are much more dependent on the debt markets for financing, and therefore they are much more dependent on the health of long-term interest rates. Now, if you think about a company like Microsoft, right? Even large companies like Microsoft, they do issue corporate debt on a regular basis. However, they tend to get, one, more favorable rates. Two, they have so much cash on their balance sheet that in fact they're earning interest on those cash balances. And this interest that they're earning helps them offset the cost of borrowing any money from the capital markets. However, small cap companies, small businesses don't have that luxury. Small cap companies typically operate on a cash flow basis, as in cash is the lifeblood of their ability to run their business. They have to borrow. If they run out of cash, they have to borrow from the capital markets in the form of bonds or debt or through secondary stock offerings. And long-term interest rates have a huge impact on the cost that they have to pay whenever these small companies borrow from the capital markets. Now, if you think back at late summer of 2023, right, just look at the stock chart for the S&P 500 about 8 to 9 months ago. Markets swooned in that late summer timeframe. August, September, October, markets were pretty down. Long-term rates had climbed very high during that timeframe. The 10-year interest rate almost touched 5%. The 30-year long-term interest rate was above 5%. And if I remember, home mortgage rates at that time were over 8%, if I remember clearly. And the S&P 500 hit its low for the year Based on the last 50 years of S&P 500 performance history, we can see that when the 10-year long-term interest rate gets very close to or even crosses 5%, stocks tend to struggle in the short to medium term. Now, Josh Brown from Ritholtz Wealth, Josh Brown and his team, they did some research on this front. And what they found was since 1978, right? Since 1978, when the 10-year interest rate crossed above 5%, the 3-month forward return for the S&P 500 was a negative 4% lower. The 6-month forward return was a negative 10% lower when long-term interest rates crossed above 5%. So markets definitely don't perform that well when we see the 10-year interest rate specifically go above 5%. So watch that 5% rate line for long-term bonds. This is more important than you think. If you're an investor in equities in the US, this is much more important than you think. This is definitely something we need to keep an eye on. And finally, let's wrap up this discussion on the health of the US economy by talking about AI. And more specifically, let's talk about how AI is likely to shape the future of the US economy over the next several decades. Now, McKinsey is a very large consulting company, and they did some research on this front. And McKinsey estimated that AI's impact to the US economy over the next couple of decades is going to be over $25 trillion. The launch and explosive growth of the mobile industry of about 10, 15, 20 years ago, that boosted the US economy by about $5 trillion. So AI is estimated to boost the US economy almost 4 to 5 times what the mobile industry brought to the US economy. According to Crunchbase is an online platform that keeps track of startups and funding. According to Crunchbase, there are nearly 10,000 AI startups today. However, there is a 5-time surge in investments in these AI companies just in the last year. Almost $22 billion have been invested in generative AI companies in the year 2023. These startups are facing strong competition from mega cap companies like Meta and Amazon and Microsoft and Google. These mega caps are investing billions of dollars of capex in building out their AI infrastructure as well as developing new AI solutions. Just in the year 2024, this year, it is estimated that these mega cap companies are going to be investing over $179 billion in capital to build out their AI infrastructure as well as develop new AI products. Last year in 23, the mega caps spent $140 billion on AI-specific capex, and this year they're ramping it up again. Now in January this year, the consulting firm Deloitte conducted a survey of almost 2,800 business and technology leaders. They wanted to talk to them and understand what these business and technology leaders are planning to do in AI and with AI within their organizations. But what Deloitte found was that people tend to overestimate the effect of an emerging technology like AI in the short run. And on the flip side, people tend to underestimate its effect in the long run. So this phenomenon has occurred many times in the past, and it could very well happen again with generative AI. Now, this is interesting, though, that with generative AI's dizzying pace of change, the gap between that short-term and long-term could be measured in days and weeks or months, and not in years or decades. So overestimating the short-term impact and underestimating the long-term impact for the previous revolution, let's say for the mobile revolution, that played out in years. But doing that in the AI space, AI is moving at a much shorter and much faster timeline. And so the short term and the long term could be only about days or weeks or even months away from each other. Some of the key findings that Deloitte found through this study: one, is that excitement about generative AI remains high, and companies are expecting fairly large positive impacts to their operations, to their business within the next 3 years. So they're expecting to see a positive impact from generative AI within the next 3 years. Many of these leaders are quite confident about their ability to try out and adopt generative AI solutions within their company. Now, they're also feeling the pressure and they're feeling threatened, right? This is creating a lot more competition between them and their peers. As they compete within a specific market, generative AI is adding another layer of competition. Now, these companies are expecting, 91% of these leaders are expecting generative AI to improve their productivity over the next 3 years. So what's coming up over the next couple of weeks in the financial markets? As I mentioned before, the US Feds have their next meeting on April 30th as well as May 1st. I'm not expecting a rate cut at this meeting. Chair Powell will announce their rate decision, and he'll conduct a press conference on May 1st, on Wednesday, May 1st. On Tuesday, April 30th, we're also going to get the ISM Manufacturing Index report for the month of April. This is one of those leading macro indicators that I follow. In the month of March, we got a really nice green 50.3 reading. And this month, for the month of April, their analysts are also expecting another growth reading of above 50. On Friday, May 3rd, next week, we will get the unemployment report for the US for the month of April. Unemployment right now is at 3.8% for the month of March. And like I said, we created more than 300,000 jobs in March. And then on Friday, May 3rd, we will get the ISM Services Index report for the month of April. So that's all I have for this episode of the Market Whispers podcast. Drop me a question or comment anytime. I'd love to hear from you readers. Until we chat again, good luck in the markets. Stay healthy, stay safe, be kind to others, and take some time to do something you enjoy. After all, that's why we invest: for life, for love, and for happiness. This is Beachman signing off. Thank you and goodbye.